We are cautiously optimistic because, of course, we've seen many false starts with China economic stimulus. And, of course, one would be looking back to the closest time of that big stimulus around Shantytown program that was in around 2016. So I think we're not really going to get that level of in excess of 2% of GDP. I don't think we should be expecting that. And second reason we shouldn't be expecting significant stimulus now, because it potentially could be spaced out for the next few years. Specifically, of course, because Chinese government will have to keep some powder dry. Of course, we know what's going to come in November, potentially. With elections, there could be a big, major surprise to China. We've all been talking about 60% tariffs coming from potentially Mr. Trump. So I think Chinese government will have to think about how to stimulate the economy. And if and when we have that situation resolved on the political side, I think Chinese will decide whether to really divert part of that stimulus towards supporting the exporters after such a big hit.
You know, they're going to keep powder dry and also space it out to make sure they have enough when they actually need it. Push come to shove, depends on what happens on November the 5th, right? How does that make you view Chinese fixed income debt bonds?
We see it in a positive way because, of course, we will have another 50 basis points or equivalent of that in market rate easing. So I think we already had a major move, which we haven't seen since 2018 in its magnitude on the monetary side. So I think this will obviously be very supportive for the Chinese bonds. And I think at the moment we're also seeing the appreciation of renminbi pressures, although we see fundamentally that's probably not going to really lead to any significant appreciations simply because of the potential impact, as I mentioned, on the tariff side.
I got to ask you, though, simply because expectations ahead of the NDRC were just so incredibly high, right? You're saying, look, it's not as though they don't have the money, but they need to be very careful about how they use it, space it out, etc. What's going to happen to the Chinese stock market then? Because, I mean, as you well know, right, it's been on a tear, right? 30% or so in just the last 3 months or so since they did that first round of bazooka or mini bazooka stimulus, right? And a lot of people still remember what happened back in 2015 with China markets. It was a roller coaster. It was up, and it basically lost everything in just a matter of months. What's to say that it won't happen this time around?
Well, first of all, the extreme bearishness that we've seen in the markets around China and disappointment with its growth program, I think that was really drove that rally, sharp rally back as investors were really trying to avoid any disappointment into the year end and really trying to catch the market. So I think that's the reason why we went from approximately maybe 20% of underweight overall of the market in the China equity side to a broadly neutral position. So of course that has been effectively a reflection also of the valuation. China was about 40% cheap to its fundamental value. So therefore a lot of investors were very quick to take this opportunity to bring back their positions to neutral because of that. Because really a FOMO effect. So I think that's the reason why I don't really think we're going to see such a big roller coaster. We'll probably find a floor somewhere around here, and I think we will continue looking for some new fiscal measures that will be unveiled.